Hey, Eric here from 5minuteinvesting.com. So today I want to talk about fundamental analysis. And before you start fundamental analysis, there are two types of companies that you must know. Now, a lot of people are not sure how to do fundamental analysis, or they have questions, or not sure what they should be looking at. And that's what this video is about. And before you start doing your fundamental analysis, and that means looking at the company's balance sheet, cash flow, income statement, you need to know what kind of company you're looking at. Is it a growing company or is it a near bankrupt company? Now, this is very important because the things you look at are almost completely different. So when you're looking at a company that is growing, which is usually what you want to invest in, you want to look at obviously the last 5 years of growth. You want to look at the revenue is growing. You want to look at the net income is growing. And you want to look at the earnings per share. Now, when you're doing fundamental analysis, you got to keep in mind that management, that means the company's upper executive, CEO, CFO, can manipulate these figures. But then they're audited by auditors, that's my job. So chances are they're 80 to 90% reliable and they're always conservative. Sometimes there are scenarios where the company is aggressive, and when the company is aggressive in recognizing revenue or net income, that's when you want to be careful because you're going to be too optimistic in the company's future performance. This is where, the famous fraud of Enron happened, where they aggressively recognizing revenue ahead of time. Okay, putting that aside, there are two types of companies, which is a growing company and a near bankrupt company. So for a growing company, you look at 5 years of revenue to see that it's growing, unless you know why a certain year it is not growing, and that is very important to know. Same for net income. You want to make sure they are making money. Now, you might want to invest in companies that are not making money yet, like Amazon or Facebook before it start making money, or Alibaba, another tech company. Usually tech companies don't make money right away. So at that point, you need to look at other factors like revenue or book value that will give you a better clue on a company's performance. So once you look at 5 years, you probably want to drill down to quarterly as well. So at this point, you want to look at if there's a slight dip in revenue, because this usually presents a good opportunity to buy, or maybe you expect the next quarter to be lower because of some bad news or so on. This creates an opportunity to buy. So that's on the income statement side. Now on the balance sheet side, you want to look at cash briefly. You don't need to place a lot of emphasis on it because chances are if a company is growing, they can raise money, so it's not a problem. And second is the amount of debt they have. Now, if a company has no debt, it's not risky as a company who has a lot of debt. So when you're thinking about how much is a lot of debt, so you sum up the total amount of debt and compare with the total amount of equity. So if it is around 1-to-1 or slightly above 1-to-1, that is okay. That's usually my comfort zone. If there is a company that's like 90% debt with like almost zero equity, that means you're paying a lot of interest and the chances of the company surviving is really low. But if the company is public, they can just raise money to pay off the debt. So you got to think about their ability to raise money, the amount of debt they have, and how much of that debt is relative to equity. And that is what you would focus on the growing company side. Now, when you're investing in a second type of company, the bankrupt company, the things you look at are different than the growing company because this company is in distress. You're not sure if this company will continue for the next year. You're not sure if the company's management can turn this company around. So instead, what you want to look at is a pure balance sheet side instead of net income. Because if you look at the income statement side, they're doing poorly. Chances are sales is going to decrease and so on. So your EPS is going to be negative, so it's not really helpful. So you want to look at the balance sheet side. And when you're looking at the balance sheet side, the most important thing is cash and again debt and debt to equity ratio, which is the things I talked about earlier. Now, but when you're looking at it, you want to look at the amount of cash they have and make sure the cash can cover at least 1 year or 2 years of the debt they have on hand. Because chances are no one wants to invest in a losing company, and no one wants to lend like money, and the stock price is tanking, right? That's why you want to buy it. Like the amounts of shares they have to issue will be a lot higher in order to raise the same amount of money because their share price is lower. So you want to make sure they have enough cash. Now, alternatively, if you know the company good enough, then maybe you know the CEO is going to sell something, or the CEO is going to take some action to make sure they have sufficient funding. And that's usually a good sign, because if there's anything that can take a bankrupt company out of business, would be not enough cash and too much debt. So you might ask, so why would you want to invest in a bankrupt company? And that's because if the company that is going to bankrupt has, $1,000 worth of equipment, okay, so the book value of the company is a lot higher than the share price right now. So the share price might be $2. So then in the end, you are still making money because the bankrupt company is worth more than what the share price is. So by buying it and later on expecting the company to go bankrupt and liquidating its assets, you actually make money, and you're almost guaranteed to make money because the book value is higher than your share value. However, this requires your in-depth analysis to know if the book value is truly correct, because sometimes there are some unexpected events like the factory's on fire, or some equipment got stolen, or like somehow the equipment is not relevant anymore, is obsolete. So this is what you need to think about when you're looking at the balance sheet of a bankrupt company. So before you start your analysis, make sure you figure out which kind of company you're analyzing, and then that will save you a lot of time and make sure you're looking at the right thing. If you have any questions, feel free to leave a comment below or give me a like. That's all I'm really going for here, and thanks a lot.